And welcome back. In today's video, I actually have a special guest that is Dan Frio of the Rate Update, a great YouTube channel. If you guys want to take a look at his YouTube channel about why rates fluctuate on a daily basis. But Dan, thank you so much for joining me in today's
You
video.
bet. Hey, thanks for reaching out. It's a pleasure.
Absolutely. So I was just telling Dan offline here that he's the only YouTuber I watch regarding the U.S. housing market. I tend to watch other videos outside the housing market because I, research this every single day, all day. So Dan is the only one to actually watch his daily videos about why rates fluctuate each day. So anyways, I want to bring on Dan because he's obviously I should say, for those of you who don't know you, Dan, if you can provide kind of like a brief bio of what you do.
Absolutely. Again, my name is Dan Frio. I'm actually with Allied First Bank. It's a federal bank located in Illinois. And the reason why I joined the bank is because of YouTube. We have a huge presence on YouTube. We get a lot of people calling in and emailing in, requesting, to see if they can buy a home. And I've been in the mortgage business for this January will be 33 years. So I've seen the good, the bad, the ugly, and today. So that part of it is that being with the bank allows me to actually have a federal license. So I'm licensed in all 50 states as well as Puerto Rico, but we're also one of the country's largest mortgage brokerages. And that's kind of a unique situation because most brokers, they're either a broker or a bank. And if you're a bank, you have your lending products that the bank has. And if you're a broker, you have a bunch of other options, but it's hard to do every state because it's almost impossible to get licensed in every state. So we actually combine the two of these together into the perfect platform. So we're set up with almost about 80 different lenders. And what we could do is we offer their programs and their rates to our viewers. And so that's basically what we do. And on a daily basis, I do like Jason. He's one of I've been talking to him for a long time, reaching out to him because I love his channel. And like he was saying about me, I watch his channel too, because so many of the channels out there are just doom and gloom. The world's going to end. The housing market's going to crash, 500%, and it's going to be worse than 2008. But on my channel, what I try to do is I try to explain, here's what's going on, and then the whys behind it. And at the beginning of this year, for example, I came out and I said, and I was getting backlash from everybody. I'm like, the housing prices aren't going to crash because there's no dynamics in price crashes. Now, I didn't foresee rates going to 8%. And we hit that, and now that's I think what you want to talk about a little bit. So that's kind of me.
Thanks, Dan. Yeah, I reached out to Dan because he is the guy who I go to on YouTube to find out why rates are fluctuating each day. And what I noticed today is that rates decrease, I would say nosedive yesterday and today as well. So looking at daily rates today, which is Thursday, November 2nd, daily rates are around 7.5%. That's more or less a 1 month low and also a decrease of 37 basis points over the past 2 days. So we went from 8%, I think it was 8.03% about a month ago or so, and now we're at 7.5%. Still high, especially in account for the fact that prices are still high, but a giant decrease in rates, which I'll share with you guys if I can here. I am kind of new to sharing my screen here. Let me see if I can do it.
While you're looking for that, it is crazy how rates went from 8% to 7.5%, kind of like within 24 to 48 hours. Now, I've been doing this a long time. I've never seen rates drop that much in basically a 24 to 48 hour period. Since the Federal Reserve came out yesterday announcing they're not going to make any changes, but then a lot of the dynamics behind the scenes, I think we'll talk about a little bit further, is really playing a big role in this. So yeah, you can see the rates are just
7.51. So this is the rate today, which is Thursday, 18 basis points decrease down from the 12-month high of 8.03%. And also looking at the, can you see my screen here?
Yep. No, and again, that 8% was just Friday, so it wasn't even a long time ago.
So here we are right here, 7.51%. And
Right.
2 days ago, let's just call it October 31st, we're at 7.88%. So nearly a 50 basis point decrease in the past 2 days, which is absolutely insane.
Yeah.
And Dan, you were saying in your 33-year span of being a loan officer, you'd never seen that before?
No, I've never seen that moves like this ever in history, basically. I mean, when we had the run up about a year or so ago, every day it would click up. I don't know if you remember, we were all doing videos about a year and a half ago when if
Yeah.
rates hit 4%, oh, the housing market's going to crash. And then it moved over to, well, now if they go to 5%, now if they go to 6 or 7, now we hit 8%. And one of the reasons, and maybe I won't speak for you, is I try not to watch a lot of the videos out there because everybody just has the doom and gloom, the housing market's going to crash and all this other stuff. We all know fear sells. But what I try to do on my channel, and that's why I watch Jason. You're one of the ones I watch, you and a couple others, just to get really the context of the economics behind things and things like that. The problem with a lot of channels is they just preach out or spiel out the doom and gloom and the fear, and people flock to it, and then and so forth. So what I try to do on my channel, just as like you do, Jason, is I don't care about I care about the data, but I just want to present to the people out there that are looking to maybe buy a house, what's the real facts. Because you see some of the markets, like in the markets you are, how's your market doing, in regards to prices? Is it up, down, way down? What are you seeing in your local market?
Yeah, in Sacramento, I'm an agent here in Sacramento, and so we're still down compared to pre-COVID levels
Yeah.
greatly. So we have like a lack of supply because people don't want to give up their 3% rates, which is a very, very common scenario we have nationwide.
Yeah.
But what I really want to focus on and really in today's video really is like, why did rates? So
Sure.
obviously rates decrease a lot. I've been talking about rates almost on a daily basis, just like you do. And we've been seeing this run up in rates. I think in August, there was only a few days in which rates actually decreased on a daily basis
Yeah.
and they increased to a 23-year high.
Yeah.
So now they're at 7.5%, which is still high, again, when you account for the fact that prices are not down compared to a year ago. So we have elevated prices and rates, which is making housing affordability at all-time record lows based on a lot of reports here. But
Right.
really, the main reason why I want to bring you on really is if you can provide some context regarding why did rates decrease so much yesterday and also today. I think there's going to be some misunderstanding regarding this because the Fed again announced yesterday on Wednesday that they were not going to, or they basically took a pause on any rate hikes on Wednesday. So they decided not to change the federal funds rate. So I know why rates have been decreasing over the past couple of days, but I want to have you on the channel to kind of provide some
Sure.
really kind of more in-depth analysis regarding why did rates decrease so much over the past 2 days? Is it due to
Sure.
the Fed announcement, or is it due to other announcements by other economic news?
Great question. So there's a lot of pieces of the puzzle. Okay. So let's first talk about why the Fed's doing what they're doing and what caused it. So the first thing is, like you were just saying, the Fed controls one interest rate. That interest rate is called the federal funds rate. What that rate is all it is if one bank at the end of the day needs money. So every bank out there that's FDI insured, they have to have a specific amount of money in reserves each day before they close. So if they're ready to close and they don't have enough money in their coffers, they have to go out and get money lent to them to be able to shut down for the day. So they have enough funds. The interbank lending of that monies is basically the federal funds rate. So now what happens with the federal funds rate is now bank fees are going up. So now the bank's now going to start changing their interest rates. And what the banks control basically are short-term rates. Okay, so in items such as your car payments, credit cards, those are the main personal loans. Those are the main things affected when all this happens. Okay, so a lot of people will say, well, when the Federal Reserve they were raising rates, a couple months ago, why didn't mortgage rates go up in accordance to that? Well, they did eventually, but mortgage rates are actually tied to a bond. And and it's called the MBSs. It's a mortgage-backed security bond that trades actually on Wall Street. So you can buy it as investments, hedge funds buy it, and so forth. So what's been happening is you'll hear a lot more about this if you haven't already in the last 6 months or year, is what's called the yield curve. Okay, so a lot of people are right now predicting, well, we're going to be in a recession because the yield curve is telling us this. So the yield curve is basically, it gives you the dynamics behind where short-term rates are and long-term rates. Okay, so right now, if you go to a 10-year or 2-year treasury, the rate on that 2-year treasury, and it's a treasury bond. So how the government, how they bring in money is the government issues treasury bonds to fill in the void of how much revenue they're collecting and how much they're spending. Okay, so they're issuing bonds out there. Well, what you have to understand is what actually caused rates to go down as far as they were, and then we can kind of pivot over to where we are now and then what's going on. So what happened back in 2008 and 2010, the housing crash. The housing crash was basically predicated by subprime mortgages, and we won't get in on that on this channel. But what happened at that point, the Federal Reserve stepped in and they're like, okay, we got to fix some things. So they jumped into the market and they started what you call quantitative easing. Now, what quantitative easing is the federal government, or the Federal Reserve, I'm sorry, steps in and they were buying treasury bills, the U.S. Treasury bonds, and they were also buying what we call the MBSs, mortgage-backed securities. So how bonds truly work is this. As the price of a bond goes down, the yield goes up. Okay, and I'll make an example of this so a lot of your viewers can understand this. Let me just, in my simplest terms, say it this way. If I had a bond today that's maturity value, let's say next year, is worth $100. Okay, so next year when I give you my bond, hand my bond to you, you'll give me $100 back. Okay, so let me show you how this works. Let's say today I give you $100 for that bond, and then next year you give me $100 back. Well, what's my rate of return? Well, my rate of return is zero. I gave you $100 and you gave me $100 back. So my yield is zero. Now, let me show you how, if the price goes down, how that really jacks up the yield. So let's say today I give you $50. Then next year you give me my $100 back. What was my rate of return? What was my yield? 100%. It doubled. So you can see how if the price goes down, yields go up. Okay, so what's been happening since, especially since COVID, the Federal Reserve has stepped in and they were buying mortgage bonds, like I think it was $40 billion a month in bonds, mortgage-backed security bonds. That artificially drove up the prices because they're buying and buying and buying. It's like any other, you buy a widget. The more you're buying, you're driving up the prices. Okay, so that's basically what caused rates to go to the lowest levels. I've been doing this 33 years. I refinance at 2.5%. It's like free money. So that's what truly was happening. They kept buying these bonds. So now what's happening is completely the reverse. Now they're saying, okay, there's way too much inflation in the mix. We're not going to buy bonds anymore to artificially reduce rates and everything else. So what we're going to do is quantitative tightening. So now not only are they not buying, creating the prices to go up, they're selling into this market. So what's happening when there's way too much supply of anything, the prices go down and down and down. Because not only do you have mortgage bonds that are in the market right now for people to buy for investments, you also have corporate bonds, which a lot of companies need cash right now and they're refinancing, or they might have their bonds coming due that they have to reissue at much higher rates. But now you have the Treasury, the federal government, way overspending. And here's where I get myself into trouble. We have a deficit.
Also talk about when they have too much of they're selling too much of that, then the prices go up, right?
Yes. So the prices are going down. So what happens
go down, prices go down, the yields are going up.
Yep.
And that's why rates have been increasing so much the past several months.
Yeah. Plus there's also a risk premium. So let me get to another piece of this. Now you have short-term rates where the Federal Reserve has jacked short-term rates up to the highest level we've seen in, say, 30 years. So now a lot of people, here's where I get to the inverted yield curve. Now you have 2-year treasuries that have a higher interest rate. They're paying you higher interest than a 10-year treasury note. Okay, so let me kind of make this make sense to you. If you were to invest your money and you were to invest and say, Jason, you're going to tie up your money in a CD for 6 months. Your interest rate, what do you want on that interest rate? You might say, 3 or 4%. Okay, now Jason, if you want to tie up that money for 10 years, are you still happy at 3%? Well, no, you want a higher rate of return because you're locking up your money for a longer duration of time. So when you're talking short-term rates, they should be down here and long-term rates should be up here. What's happened is they reference this as the inverted yield curve. Our short-term rates are higher than long-term rates. And it's basically screwing up the whole system is basically what's happening. So not only that, you have a lot of people now saying, especially in the mortgage bonds, well, even the Federal Reserve keeps coming in saying that they're going to start, easing on interest rates in 2024. So now a lot of people are saying, well, I don't want to buy these mortgage bonds at, 8% interest rates because a lot of these people that take out these 8% interest rates next year, they're going to refinance to a lower rate, let's say 6.5. So my bond now will get called due. And now I got to take my money and find another investment to put that money into. So they're requiring a bigger risk premium. So now that's what's really causing mortgage rates to go even higher than they should, because that risk premium, which is usually about 150 basis points from the 10-year treasury, is now like 300 basis points or 3% higher. And that's basically what's been causing mortgage rates to skyrocket.
Yeah. So just take a step back here. You're saying that the spread between the yield on the 10-year treasury bond, historically speaking, is around, would you say 150
basis points from basically where the mortgage bonds trade. And that's why a lot of people watch the 10-year treasury, because you can say, okay, if the 10-year treasury is here, if it ticked up a little bit today, well, mortgage-backed securities probably going to tick up about the same amount.
Right.
Well,
yeah, because the 10-year treasury is at 4.6, 4.7-ish right now.
Yep.
And it's the spread between that and the 30-year fix mortgage rate is about 300 basis points or 3 percentage points.
Right.
About,
normally that spread is about 150. So that's why I've been predicting, I'm like, rates should be 6.5, 6 to 6.5, based on where the 10-year treasury is. If we were in a normal market, we're not in a normal market. Okay. So there's so much other dynamics behind everything, but that's kind of what's going on right now. A lot of people aren't buying mortgage-backed securities because even the Fed came out and said they're going to start reducing rates next year. And then, why has the Fed done what they've done? Well, inflation. Inflation played a huge role. It was, just think, a year and a half ago right now, inflation was like 9%. Today it's 3.7. No, it's not the 2% that they were looking for, but it's actually coming down. And then what actually happened between yesterday and today, now we're starting to see a lot of cracks in the foundation. Now we're starting to see not as many people getting jobs. Today, the big news today is the wages are actually starting to decrease. So wage growth was going up on a monthly basis, 0.5%. So that makes huge, that basically what the Fed is saying is people have too much money and they're spending all this money. That's what's driving up the cost of everything. Again, if you have too much money into the system, you only have a finite amount of goods and services. You start, as you're buying and buying and buying and buying, you're jacking up those prices.
Yeah, absolutely. So maybe we can talk about that because, rates obviously fell big time yesterday and today.
Yep.
And so when talking about why that happened, you're talking about cracks in the foundation here. ADP, I'm not a big fan of ADP, but I know that does affect.
I'm not either. They changed their algorithms about 6-8 months ago, and it's still not they're still pretty far off.
Got it. Well, the ADP employment change in October came in at 113,000, but the forecast was 150,000. So far fewer jobs available, even though it's still far higher compared to September here at 89,000, but well below expectations of 150,000. And what was the other thing the JOLTS? The JOLTS came in at 9.553 million, well above the forecast, but more or less flat compared to 1 month ago.
Yep. And if you look at the ISM manufacturing employment numbers, the
Yeah,
previous
right.
reading was 51. Now it's 40. I think it's 46. So now
Yeah,
you're starting to
46.
see the cracks in manufacturing or people working in manufacturing. Then also some really good news out today was, I don't know if you have it on your screen, was wage
Yeah.
growth. It was actually down 0.8%. I don't know where it's on there.
Unit labor
Yep,
costs?
right there, right there. Now that's the biggest, that's the sticky
Yeah.
point with the Fed. They keep saying, if you see before that, it says labor cost up 3.2%. So think if you're a company, or Jason, say you have employees and your costs are going up 3.2% a month. A month.
Yeah.
You're going to get to a point where you're paying so much out that what are you going to do? Well, you have to, you're a servant to your shareholders. So as a company, you can't really make less money or your stock's going to tank. So what do you do? Well, if you look at the hours, average hours worked, productivity, hold on one second, if it's in there somewhere.
Non-farm
Well,
productivity?
yep. It's yes.
Or
So
productivity?
right there, you're saying now the employers are getting more and more out of their employees with less employees, and they're not having to pay them so much. So though
Mhm.
that news for the Fed was completely great news, because now they're saying, okay, if people don't have as much money to spend, they obviously can't spend it. So that in turn is going to start driving down inflation. And now you start seeing, with the credit card debt, is it I think it's 1.4 trillion or 1.7 trillion dollars, the highest level ever. So
Yeah,
people continue to spend, but they're putting it on credit cards. So
right.
there is going to be a huge crack in the foundation here. It's already started to take effect, and I don't know how many comments you get from your subscribers, but a lot of people, I mean, they're tightening up their belt buckles, and they're working paycheck to paycheck to just make ends meet. Once a lot of this filters down and is seen by Wall Street and the Fed, you're going to really start seeing the Federal Reserve probably pivot sooner than they expected.
Yeah, we have this lagged effect when the Fed increases rates. We have this lagged effect on our economy. We're seeing that, but yeah, you're right. Kind of seeing like the initial cracks, all-time record highs for credit card balances. What else was there? What blows my mind is the MBA, the Mortgage Bankers Association, their weekly
Yeah.
update regarding how many people are submitting loan applications for refis plus purchases.
Yeah.
We all know that purchase applications are at the lowest level since 1995. But what blows my mind is that refis represent about 30% of all loan applications, according to the latest report here. And when I read, do you follow Black Knight?
Yes.
Black Knight,
Yes.
yeah.
Yep.
So what their mortgage monitor from a month ago stated that, what was it, 90% of all the people who locked in rates for refi were for cash out refi when
Mhm.
rates were close to 8%. So that was a mind blowing stat, because 90% of the people who are doing, or those people who are doing refis, were taking on a higher rate. And so,
Oh yeah,
why would people
I
take on a
have
higher rate?
several. Yeah, I have several. So I
Mhm.
mean, what's happened is, during COVID, and this is another area where people have comments about what I say on this, but during COVID, if you actually, I don't know if you could pull it up on your chart, but if you look at consumer disposable income. Okay. Normally, how the chart runs, it goes back from 1965, and it runs, and it gradually increases. Everybody tries to save some money, make their lives a little bit better for them and their families. Then all of a sudden in 2020, that number just spiked to the record high number of how much money people have in their accounts in the bank. And why? You're like, okay, what happened? Actually, COVID took place. So how did more people have this excess money? Well, in you didn't have, during that time during COVID, many people, if you had a loan with Fannie Mae or Freddie Mac, you didn't have to make a mortgage payment, and you didn't have to make a mortgage payment for almost 2 years. And then what you had is student loans. Student loans were on deferral, and they just started back up last month. So just think about it even in your situation, Jason. If you didn't have a mortgage payment or any student loans, in my case, I'd have no bills. So what would I be doing? I still worked during that whole time frame, and then a lot of people also got stimulus money. So all of a sudden, you had all this money. It's called the M2 money supply. It's how much we all have in the bank. That it just spiked to the highest levels ever. And then, so you might say, well, how and why? Well, that's how, because a lot of people didn't have to make a lot of the major payments that they had to make on a monthly basis. Plus, a lot of them still were working, and a lot of them were getting stimulus checks. So
Yeah.
that was what created a huge amount of money in circulation. And then on
Plus
top of
having
that,
3% mortgage rates, and on top of that.
yeah. So then on top of that, you had a supply chain issue, which limited the goods and supplies. So you have, again, all this money chasing few goods because of the supply chain issues. What's it going to do? It's going to drive up prices, but people kept spending and spending and spending. And then now the money supply is tanking. And people are still trying to keep up, with their habits, I guess. And they're starting now to put it on credit cards. And if you start looking at the M2 money supply on how much money is out there, it's dramatically plummeting. And then our consumer debt is starting to skyrocket. So, and then the last thing here, and I know I talk a lot, so my apologies, is
We do need to wrap it up. But yeah, this is really good now.
student loan debt just kicked back in last month. And I did the calculations. I think there was, what was it? It was like $26 billion a month is going to now be allocated to student loan debt, starting now. So just think about that. 2 months ago, that $26 billion in monies wasn't being allocated to student loan debt. People were just using that money and spending it. Because again, if you look at the savings rates, the M2 money supply, it's been plummeting. So people don't have as much money now, and they're now starting to charge it. And now the student loan debt's going to kick in. So this is going to take a lot of money out of circulation, and that's going to really start driving down inflation. And those are the dynamics right now behind everything. So as you start seeing data come in, like the Federal Reserve comes in each month when they talk to us, and they're like, okay, we're going to still be data dependent. Every day that we get a little bit of data saying the economy is starting to shrink, the payroll numbers are starting to go down, and wages are going to start to go down, you're going to have more and more positive news that the Federal Reserve will start reducing interest rates.
Yeah. And then on top of that, when we get more and more bad news, that decreases mortgage rates as well. So before we wrap up this video, do you have any theories or predictions about, potentially where we're going to land by year end in a couple months here for 30-year fixed?
Yeah, that's a tough one. When I came out at the beginning of the year, here's what my predictions were. I thought, I even said this, you can check out my videos. I figured mortgage rates would be right around 6%. I'm off there by a point and a half. But I did say that the housing market would be completely flat. You'd have areas kind of like in Southern California, Austin, Texas, and some areas that would see a drop, maybe double digits. And because people were it was FOMO, as people are overbidding, hundreds of thousands of dollars over price, and it can't be sustained. So that's basically what happened. And you see it today. Like I'm in Chicago, our house prices are up. I think they might be close to 10% this year. Which is, it's crazy. So now if you look at all the dynamics, where should rates be? Rates should be, based on the federal funds rate and everything else, should be about 6.5%, 7%. That's where I'm seeing rates in the next 6 months or so. But I'm still, like you were saying at the beginning of this video, when I asked about your area, there's still no supply out there. And a lot of people think, it's that isn't true, but it is true. There's not a lot of people, especially existing homes, are being sold. So that is basically putting a bottom of where prices can't tank, because what causes prices to go down? An oversupply of something, and we don't have an oversupply in the housing market.
Yeah, absolutely true. And I talk a lot about supply side and the demand side. Obviously, we all know that the demand side is down big time, but you can't have a housing market crash unless we have a glut of supply.
Right.
And kind of an interesting thing that happened last year is that even though inventory, or the amount of houses for sale, was way below pre-COVID levels, we had a correction in our housing market, but that was really because of the pace of the increases of inventory, not really due to an increase or a surge of new listings, or due to inventory increasing above pre-pandemic levels. So we can see that we can have this dynamic in which inventory can increase, which will cause prices to fall. But like you said, there's a lot of people who have these low rates and they're not being forced to sell. And so I'll say it again, is that I don't foresee a significant decrease, more than we saw last year, unless people are really forced to sell. You lose your job, you're out of money, you need the equity of your houses to live. And so we're not seeing that yet. Maybe potentially next year, I don't know. But I really don't see that we're going to see like any crash anytime soon, because the supply side is still very low. Even though the demand side's low, doesn't mean that we're going to have a housing market crash.
Yep, I agree with you 100%. Unless you're the problem with, or I'll say what happened in 2008, people were forced to sell their homes. They were in subprime mortgages, millions and millions of them were. Their house payment kept going up and up and up because of the structure of those subprime mortgages. That's what basically caused the crash. And everybody was financed at 100%. So they didn't have any options. They're like, I'll just go into foreclosure. I'll just throw my house on the market and just walk away because there's no equity there. When today's market, most people have a ton of equity. Even if you bought 2-3 years ago, you have enough equity that you don't have to go into foreclosure. You can actually put your house on the market just as a standard, the normal prices in your area, and it should sell. So that's why, I've been predicting that we would not have a crash, because people are not forced to sell. So unless we have a huge recession that causes, a huge jump in unemployment, thus causing, financial stress to people, you won't have people being forced to sell their homes. So that's basically the dynamics behind that.
Yeah. Well, I appreciate you joining me, Dan, on short notice too. I emailed you yesterday saying, hey, man, rates are falling big time and you want to do a collaboration. So I appreciate you joining me in today's video. And anyone who's not following Dan, I imagine there's probably a lot of people who already follow you on your YouTube channel. But if not, I'll leave a link in the video description below to your YouTube channel. But yeah, Dan, thank you so much for joining me in today's video.
Appreciate it, buddy. Have a good one.
Absolutely. And thank you everyone for watching. Appreciate you. Like and subscribe, and we'll see you on the next video. Thank you so much.
Take care. Bye-bye.